Now, one of the biggest economic stories of 2024 will be the Fed's trajectory on interest rates. Last month, the Federal Reserve policymakers concluded that inflationary pressures were easing and held rates steady. The Fed minutes signal that the central bank expected to cut rates 3 times in 2024. Now, these decisions will undoubtedly affect the housing market. And according to Freddie Mac, the 30-year fixed rate mortgage plummeted more than a percentage point between late October and mid-December. However, since then, rates have remained relatively unchanged. The 30-year fixed rate average in the U.S. sits at 6.62% as of January 4th. And joining me now is Andy Walden, VP of Enterprise Research Strategy for ICE Mortgage Technology. Andy, so great to have you here in New York.
Thank you. Appreciate you having me.
Well, first and foremost, we all know that 2023 was a very challenging year, especially for the American home buyer when it comes to the housing market. So are you more positive when it comes to the outlook for 2024?
I think we are, and you just talked about the reasons why, right? The Fed has started to show signs of easing throughout this year. It should lead to interest rates easing, and so if we look at the interest rate forecast and how that's shifted over the last couple of months, provides a little bit brighter outlook for 2024. We've already seen refinance incentive pick up a little bit. Throughout the year, we could see some of those borrowers that chose to jump in and marry the house and date the rate, as it was said last year, may have some opportunity to refinance as it gets into the late stages of this year. And home affordability has improved a little bit entering this year as well, to its best level since May. Still a challenge, but moving in the right direction, and that's the expectation for 2024 as well.
And Andy, of course, when it comes to the housing market, supply and demand, in addition to rates, that plays a huge part. So what do you expect to see moving forward?
Yeah, and I mentioned that the demand side has started to improve. Home affordability has started to improve over the last couple of months. That's the expectation for the remainder of this year. You've started to see purchase demand come back with that. We're still at about a 39% deficit versus where we were pre-pandemic levels. Supply has started to improve as well over the last few months, almost universally across the country. 98% of markets have seen their inventory levels improve. So we're in a kind of a unique position right now where 40% short on supply, 40% short on demand. It's led to kind of neutral home prices right now. But the story of the 2024 housing market is really going to be told by where do interest rates go here over the next few months as we move into the traditional spring home buying season. Do we see a leg down and demand return and home prices heat back up like they did last spring? Or do we see a leg up in rates and it kind of soften things out and leads to a little bit easier home price environment this year? So a lot of that's going to be dictated by simply where the bond markets go and where 30-year rates go over the next couple of months.
And Andy, that leads me to my next question, which is about homeowners' level of equity.
Yeah.
So according to a recent ICE Mortgage Monitor report, you showed that American homeowners' level of equity are close to some of the highs that were reached at the height of the market back in 2022.
Yep.
So how much equity do American buyers actually have access to right now?
Yeah, and that's been one of the beautiful byproducts of what's happened in the housing market over the last 4 to 5 years. Obviously, those rising home prices have put those challenges on home affordability, but they've led to record levels of growth in 2022, and we're still back to those levels, or back near those levels as we sit here today. The average mortgage holder, if we look at our metric that we call tappable equity out there in the market, there's $10.5 trillion in the market at large. The average mortgage holder in the US has about $200,000. Now, they've been a little bit reluctant to utilize that equity because it's become more expensive in a higher interest rate environment, but that does provide some opportunity as we move into later stages of 2024. If the Fed begins to ease, if 30-year rates start to come down, we could see borrowers start to move back in that direction and some increased equity utilization and equity lending as well.
And Andy, before I let you go, I do want to ask you about the future when it comes to mortgage and housing markets. So depending on whether you see the glass half empty, glass half full, there's still some out there who might be forecasting a recessionary environment.
Sure.
So what would a potential scenario like that look like for mortgages and the housing market?
Yeah, and when we look at mortgage performance right now, the strength is still there. We're still near record lows in terms of overall mortgage delinquency rates. If we look at the number of borrowers that are 3 or more payments past due on their mortgage, it's the lowest since 2006. We still have widespread forbearance and loss mitigation protections among those borrowers. And as we mentioned, they're still equity rich among those borrowers as well. And so near-term risk of default and foreclosure activity out there in the market is relatively low. But 2024 is expected to be a transitionary year, right? We're already starting to see some pressure put on lower credit score borrowers in the lower end of the market. Some of those more recently originated loans are starting to see a little bit of pressure as well. And so, the expectation as we move through 2024 is probably more conversations around delinquency in this space and probably beginning to kind of bottom out for this cycle and start to see some of that performance trend a little bit higher.
Well, Andy, a lot of moving parts as well as a lot of indicators to keep our eyes on. So thank you so much for joining me today.
Appreciate it. Thank you for having me.
Thank you.